My name is Mike Macy from Las Vegas, Nevada. My question is this. There have been some recent news articles on the problems at Lloyd's. What effect, if any, do you see the problems at Lloyd's having on an increase in the Berkshire insurance or reinsurance business?
Well, I think probably I think it's fair to say that the problems of Lloyd's have helped us because Lloyd's had a terrific reputation. It was the first stop and usually the last stop for all kinds of unusual risks and large risks 20 years ago, and the fact that they have lost some of their luster in that period has helped us. And we didn't do anything to contribute to it, but it obviously benefits us as a competitor when questions develop about an organization which has been a premier player in the industry. So Berkshire probably possesses more capital than all of Lloyd's put together, and it has established a reputation for being willing to quote on very large risks very quickly and to do exactly what it says. And it might very well be that in many cases we would get a call before they would get the call now. So we've been a beneficiary and probably in a fairly good sized way from their problems. And it's more difficult for them to make inroads on us now than would have been the case 10 years ago. We have a, I don't like to lay it on too strong, but we do have a preeminent position in a certain area of really large-scale reinsurance that will be difficult for anyone else to replicate. Now, they may not like our prices. There may not be demand for some of the things we can do, but if there is demand, we are very likely to get some very significant business out of that position, and we've seen it some in recent years, and we'll see it more in the future. Zone 5.
Mike Assail from New York City with a question for Charlie about the 100 or so models we ought to have in our head.
Here we go.
Mentioned at the end of the excellent worldly wisdom speech. I'd like to know the most useful models on industry consolidation, on product extension, on vertical integration, and any models which explain the special cases when it makes sense to invest in retailing stocks. And if Warren has anything to add or subtract, I'd love to hear it. Thank you very much.
Well, I'm glad to answer such a modest question. I spoke about having 100 models in your head, but those are all great big models of considerable generality that are useful over and over again. Now you're down into very complex sub-modeling when you get into a separate model for what's going to happen in industrial consolidations and retail and so on. And I'm not up to all those sub-models.
The truth is, we're up to a few, but we take the general models and plug them in, and sometimes the light goes on, and sometimes the light goes on, and sometimes it doesn't. But if it does, they could be quite useful. That if you focus, you do see repetition of certain business patterns and business behavior. And Wall Street tends to ignore those, incidentally. I mean, Wall Street really doesn't seem to learn for very long business lessons. It may not be to their advantage to learn it. That would probably plug right into Charlie's model.
You bet.
Yeah, it's better to if you're out selling the future, it may be better to forget the past if you're getting paid on selling it and not on betting your life on it in some way. One situation at Berkshire that really is somewhat different than many companies, we assume, and unfortunately it's an error, but we assume we'll be around forever. So when we are in our insurance business, we assume we're going to be here to pay every claim. And we're not going to retire at 65 and hand over something to someone else. And there wouldn't be any sense playing games on accounting because it would catch up with us later on. And whereas in many businesses, I don't think they have quite the same horizon on things. They do it at Coca-Cola or they do it at Gillette, but many companies are thinking about what kind of, I'm afraid that more than you'd like, are thinking about what kind of little pictures they can paint for the next 4 quarters or so, and that's easy to do, but our problem is we're going to be around a lot longer, we think, than 4 quarters, so that's not an option available to us, and we really run it as if in the year 2050 or something, somebody's going to look and say, how did it work out? Zone, where are we, 5 or 6? Wherever the microphone is. Zone 5, we got a mic over there? Maybe that was it. 6, okay, we'll go to 6. Could you get the microphone, or do we have one in there? Yeah. Want to bring in the microphone? Particularly for the people behind you, it's a little difficult.
Glenn Rollins, Atlanta, Georgia. You state in your letters to shareholders that with your wholly owned companies, you reward them at a high rate when they release capital to you, and you likewise charge them a high rate when they need capital. Could you elaborate on that?
Well, some of our businesses don't need capital at all, or need so little that it doesn't make sense to build it into a formula. So we have certain businesses, those are the best businesses, incidentally, that take essentially no capital, because it means that if you double the size of the business, you don't need any more capital. And those are really wonderful businesses, and we got a few of those. But where our businesses do produce capital, we could have all kinds of complicated systems and have capital budgeting groups at headquarters and do all kinds of things. But we just figure it's simpler to charge people a fair amount for the money and then let them figure out, whether they really want to buy a new slitter or whatever it may be in their business. And it varies a little bit. It varies on the history of when we came in. It varies on the interest rates of but we generally will be charging people something in the area of 15% in terms of working out compensation arrangements for capital. Now, 15% pre-tax, depending on state income taxes, is only 9 to 9.5% after tax. So you can say that isn't even enough to charge people. But we find that 15% gets their attention. And it should get their attention, but it shouldn't be such a high hurdle rate that things that we want to do don't get done. Our managers expect to be running their businesses for a long, long time. So we don't worry about them doing something that works for them in the next year but doesn't work 5 years out, or vice versa, where they don't make longer plans, because they see themselves as part owners of the business. But we want them to be owners with a cost attached to capital. We think it's awful, frankly, the way businesses reward executives with absolutely no regard for the cost of capital. I mean, a fixed price option for 10 years, imagine giving somebody an interest-free loan for 10 years. You're not going to do it. And if a company is retaining a significant part of its earnings and you give out a fixed price option for 10 years, they can do nothing with it but put it in a savings account, and they'll make some money off of it. So we like attaching a cost to the capital. If we had options for me and Charlie at Berkshire, which it's not going to happen, but it would not be illogical. It would not be illogical. We have responsibility for the whole place. You could have some kind of a compensation arrangement that worked in respect to how the whole enterprise fared, and it would make sense for the two of us. It wouldn't make sense for the rest of our managers because they work on specific units, and you should have compensation arrangements that apply to those units. But assuming you had it for the two of us, which we're not going to have, I want to assure you. But we would say the fair way to do that would be to have an option at not less than present intrinsic value. Forget what the market price is, because believe me, the idea of having the more depressed your market price be, the better your option price be, does not make any sense. So we would have it at not less than intrinsic value. And then we would have it step up yearly based on something relating to a cost of capital, because we would say, why should we get free use of the shareholders' capital. And we could work out a fair stock option. That would be perfectly appropriate. We won't do it, but it'd be a perfectly appropriate way to have us compensated that involved an issuance, that an initial price of not less than intrinsic value, and involved carrying costs. And then we would be in a position still not totally analogous to shareholders because we wouldn't have a downside that you have, but we would at least have the carrying costs that you have of ownership. And we work that through into our unit compensation plans by having a cost of capital that, like I say, tends to run about that 15% area. And if people can give us money, we should be able to figure out a way to do something better than 15% pre-tax with it. That's part of our job, too. So we will pay them to give us back money.
Well, we really invented a more extreme system, and that is the executives can buy Berkshire Hathaway stock in the market for cash. And this is a very old-fashioned system, but most of them, it doesn't take any lawyers or compensation consultants, and most of them have done it, and most of them have done very well with it. I don't know why it doesn't spread more.
People say they want their management to think like shareholders. Management, they compensate. We're going to have them think like shareholders. It's very easy to think like a shareholder, become one,
Yeah.
and you'll think exactly like a shareholder.
Right.
It's not a huge psychological hurdle to get over if you actually write a check.
Yeah.
Zone 1.
John Lichter from Boulder, Colorado. Are there some worthwhile books that you could recommend to us? And secondly, with respect to Eisner and Disney, how would you define Michael Eisner's circle of competence, and are you concerned that he might step outside it?
Well, I would say that he has proven himself very good at understanding what Disney is really all about. And you can look back to the predecessor management between Walt and Eisner, and they didn't really do much with that if you look at those years. What is special about Disney, and how do you make it more special? And how do you make it more special to more people? I mean, those are the things that you want to manage, and you've got wonderful ingredients to work with when you're working with something like Disney. I mean, one of the advantages we were talking about the Mayo Clinic and brain surgeons. And the nice thing about the mouse is that he doesn't have an agent. The mouse is yours, and he's not in there renegotiating and every week or every month and saying just look at how much more famous I've become in China or something. So if you own the mouse, you own the mouse. And Eisner understands all of that very well. I would say he's been very skillful in terms of how he's thought about it. I worry about any manager. It has nothing to do with Michael Eisner, but Charlie and I worry about ourselves in terms of getting out of our circle of competence, and we've done it. It is very tempting, and it's probably part of the human condition in terms of hubris or something, that if you've, as Charlie would say, if you're a duck floating on a pond and it's been raining and you're going up in the world, after a while you think it's you and not the rain, that you're some duck. But
Right.
and we all succumb to that a little bit. But I think that I think Disney, Coca-Cola, Gillette, I think those companies are very focused. I think our operating units are very focused, and I think that gives us a huge advantage over the managers that are getting a little bored and decide that they better fool around with just how talented they really are. Charlie?
Yeah. Eisner is quite creative, and he also distrusts projections. And that is a very good combination to have in the motion picture business.
Yeah, Charlie was a lawyer for, 20th century in the old days? Yeah, and he saw a little bit of how Hollywood operated, and it kept us out of buying any motion picture stocks for about 30 years. Every time I'd go near one, he'd regale me with a few stories of the past. So it's a business where people can trade other people's money for their own significance in their world, and that is a dangerous combination where if I can buy significance in my world with your money, there's no telling what I'll do.
Part of the business reminds me of an oil company in California, and it was controlled by one individual, and people used to say about it, if they ever do find any oil, that old man will steal it. And the motion picture business, it's only about half of it that has normal commercial morals.
We're not applying that to Disney.
No.
Disney is really Disney's done an extraordinary job for the shareholders, and they make real money out of movies. Most movie companies they've made money for everybody associated with it, but not a lot is stuck to the shareholders. Zone 2. Well, the books. Charlie, what are you reading these days?
Well, I'm almost ashamed to report because I've gone back and picked up the part of biology that I should have picked up 10 or 15 years earlier. And if any of you haven't done it, it's a total circus what they figured out over the last 20 or 30 years in biology. And if you take Dawkins, The Selfish Gene, and The Blind Watchmaker, I mean, these are marvelous books. And there are words in those books that are entering the English language that are going to be in the next Oxford Dictionary. I mean, these are powerful books, and they're a lot of fun. I had to read The Selfish Gene twice before I fully understood it, and there were things I believed all my life that weren't so. And I think it's just wonderful when you have those experiences. We always say it isn't the learning that's so hard, it's the unlearning.
Yeah. I made the mistake of taking Charlie up to Microsoft in December, and he became friends with Nathan Myhrvold, and they are corresponding back and forth with increasing fervor and enthusiasm about mole rats, and they copy me on all these communications, so I'm getting to see this flow back and forth on the habits of mole rats. And I really haven't found a way to apply it at Berkshire, but I'm sure Charlie has got something he's working on that. He's gotten very interested in biology lately. I've always liked reading biography, but since the computer's changed my life, I now find myself playing bridge on the computer about 10 hours a week, and unfortunately, I didn't want to give up sleep or eating or Berkshire, so the reading has been kind of light. On investment books, if you're asking about that, I would recommend the first two books that Phil Fisher wrote back around 1960, Common Sense and Uncommon Profits, and the second one. They're very good books. You know, I obviously recommend first and foremost The Intelligent Investor, with chapters 8 and 20 are the ones that you really should read. All of the important ideas in investing really are in that book, because there's only about 3 ideas, and those two of them are emphasized in those 2 chapters. Actually, I think John Train's Money Masters is an interesting book. I don't know, can you think of any others, Charlie, that we want to tout?
I don't know. We have such a fingers and toes style around Berkshire Hathaway. We just sort of count. I've never seen, Warren talks about these discounted cash flows. I've never seen him do one.
Yeah.
If it isn't,
there are some things you only do in private, Charlie.
If it isn't perfect obvious that it's going to work out well, if you do the calculation, he tends to go on to the next idea.
Yeah, it's sort of it is true. You don't if you have to actually do it with pencil and paper, it's too close to think about. I mean, it ought to just kind of scream at you that you've got this huge margin of safety. I mentioned the 3 ideas. The 3 ideas I should elaborate on. One is to think of yourself, to think of investing as owning a business and not buying something that wiggles around in price. And the second one is your attitude, which ties in with that, the attitude toward the market. That's covered in chapter 8. And if you have the proper attitude toward market movements, it's an enormous help in securities. And the final chapter is on the margin of safety, which means don't try and drive a 9,800-pound truck over a bridge that says, capacity 10,000 pounds, but go down the road a little bit and find one that says capacity 15,000 pounds. Zone 2?
Yes, Chip Tucker, Minneapolis. Mr. Buffett and Mr. Munger, what market share does Berkshire have in Super Cat insurance business? And what's your outlook for both the market growth in that business and the potential market share growth from Berkshire? You answered a related question regarding Geico's auto opportunities. Are there other insurance businesses potentially worth expanding into, or is your focus on SuperCat and auto's opportunity enough?
You know, Warren can answer that question a lot better than I can.
We don't. There wouldn't be any good market share figures in something like SuperCat. We know that a couple of years, and last year I think too, we had to be the biggest in terms of premium volume. We simply take on so much more than anyone else will, and we were getting the calls on the big risks. You know, $400 million here or something of the sort. We had a quote we put on $1 billion on the New Madrid fault here a little while ago. Nobody else will be doing that. So we got market share by our willingness to do large volume, by the fact that people knew we would pay subsequently. But we don't. While we know we were the largest, we can't give any precise figures. We also know we're slipping in that now, but that makes no difference to us. We'd only be interested if we were slipping in profitable markets. What was the second part of the question on that, Charlie? What other opportunities in the insurance business? We, just this year, we bought a very, very small company, the managers of whom are here, and a very fine insurance company. It has a little niche. It will never be huge or anything of the sort, but it's the kind of business that we can understand, and we like the people that run it, and we like the position they've achieved in the market, so we're delighted to be in it. We are willing to think about a whole variety of things to do in insurance, but most of them we find make no sense. But that we'll do other things in insurance over the next 10 or 15 years. It's just bound to happen, but I can't tell you what they will specifically be. The biggest single thing we will do in terms of value, though, probably is grow GEICO. But we will do other things, and who knows what they might be. We have expanded some in it's small business, the structured settlement business from when we talked a year or two ago, and we are the preferred provider of structured settlements. Those are annuities essentially that are payable to people who are usually the victims of a very bad accident, and so they're very severely injured people with injuries will probably last for life. And so we will be making payments to people who are incapable of earning a living, may incur substantial medical bills for many decades, sometimes 50 or 60 years. Those annuities are provided by our companies to other insurance companies and to these injured people, usually with the approval of the injured person's attorney. And when the advisors to the injured person think who is going to be around in 50 years to pay money to this person who's been incapacitated, they frequently, and in our view logically, think of Berkshire. So we have become much better known in that over the last couple of years. It's not a big business, and it won't be a big business, but it's a perfectly decent business, and it's one where we have a competitive advantage over time. We don't obtain the competitive advantage by price. We obtain the competitive advantage from the peace of mind that the injured party obtains from knowing that that check will be in the mail 50 years from now. And that's the kind of business where we have some edge, and we'll find other things to do over time, but it isn't like we're looking at some specific area and saying we're focusing on this. We're aware generally of what's going on in the insurance business, and we're very ready to move. Zone 3.
Mr. Buffett, Mr. Munger.
Zone 3. Zone 3.
Mr. Buffett, Mr. Munger, been a great deal of respect for your integrity and your wisdom. I work as an inner city school teacher where there is a rising and pervasive sense of hopelessness. When I ask my students what would make you happy, their predominant response is $1 million. As some of the richest men in the world, I wonder what your response to them might be. And as a second part of this question, the philosophical underpinnings of capitalism have largely ignored a systemic perspective involving issues of ongoing depletion of limited global resources exploited to sustain a market economy, widening gaps between the very wealthy and the severely impoverished, and an international view of America as a country whose primary values are greed and imperialism. As we move into the 21st century, do you see a need to re-envision capitalist premises towards original notions of democracy, justice, and humanitarian concerns?
Didn't get all of that. But
Well, I will say this: I'm higher on the existing social order than you are. There's always plenty wrong with a social order, and certainly there are places where ours is a lot more broken than it used to be. I don't think Warren and I have any wonderful solution to all the problems of the world, but wishing for $1 million instead of some more tangible short step is the wrong frame of mind. That isn't the way we got our $1 million.
Yeah. Well, I don't.
Warren might give a different answer, by the way. He's
No, I would agree with the wishing for a job. Makes a lot of sense to me, and figuring out how to get one, and then going from there. But there is, and always has been. That doesn't mean it always should be, but there is a tremendous amount of inequality. What you don't want is an inequality of opportunity. There will be a lot of inequality in ability. A market system like we have turns out what people want. If they want to watch a heavyweight fight and they want to watch Mike Tyson, they're going to pay him $25 million for getting in the ring for a few minutes. And it produces what people like, and it produces in an abundance, and it's done very well in terms of production. It is much better to be in the bottom 20% in this country now than it was 50 years ago, and it's better to be in the bottom 20% of this country than in any other country. But it still isn't very satisfactory. The market system does not reward teachers. It does not reward does not reward all kinds of people who do all kinds of useful things in any way comparable to how it will reward entertainers or people who can figure out the value of businesses or athletes or that sort of thing. A market system pays very big for something that will entertain them. People want to be entertained a good bit of the day, and pays better for people that will entertain than educate. I don't want to tinker with the market system. I don't think I should be telling people what they should want to do with their lives, but I do think that it's incumbent on the people that do very well under that system to be taxed in a manner that takes reasonable care of anybody that is not well adapted to that system, but that it's a perfectly decent citizen in every other regard. And that is, I don't want to start getting into comparable worth in terms of how I tax, but I do think that somebody like me that happens to just fit this system magnificently, but wouldn't be worth a damn in Bangladesh or someplace, because what I have wouldn't pay off there. Their system would not reward that. I think that we get from society. The society provides me, this society provides me with enormous rewards for what I bring to the game. And it does the same with Mike Tyson, and it does the same with some guy whose adenoids are right for singing or whatever it may be. And I don't want to tamper with that, but I do think those people who are getting all kinds of claim checks on the rest of society from that, where people who are not well adapted to that, system, but that are perfect really, fall through the slats on that. And I think progress has been made on that over the last 50 years, but I think we're far from a perfect society in that respect. And I hope more progress is made in the next 50 years. I don't think the wishing for the $1 million, though, is that it doesn't work that way. I think, but if you are lucky enough to have something that the market system rewards, you do very well here. And if you're unlucky enough to have something it doesn't reward, you do better now than you would have 30 or 40 years ago, and you do better than in other countries. But I can see where it seems very unjust to look at somebody else who has just a little different mix of talents that can achieve claim checks in a way that keeps them and the next 5 generations of their family in a position where they don't have to do very much.
I would say that I like a certain amount of social intervention that takes some of the inequality out of results in capitalism, but I hate with a passion rewarding anything that can be easily faked, because I think then people lie, and lying works, and the lying spreads, and I think your whole civilization deteriorates. If I were running the world, the compensation for stress under workman's compensation would be 0. Not because there isn't real stress, because there's no way to keep the fakery out if you reward stress at all.
There was a great article, and this applies to an earlier question. There was a very good article in Forbes about 1 issue ago that showed the occupational. There was a very good article in Forbes about 1 issue ago that showed the occupational of different intervals going back to 1900. One problem you can see just by looking at that profile is that if you assume 20% of the bottom 20%, however you measure it in terms of employability, whether it's measured by IQ or interest in working or energy level or whatever you want to do, they fit very well most of the jobs that were available 100 years ago. In other words, you could do most of the jobs, of which there were many, with relatively unimpressive mental abilities. And as jobs have changed, the profile of people hasn't changed. So there are more people that end up on the short end. Now, the good part of that is the society produces so much more that it can take care of those people one way or another. Now, the trick is to take care of them and make them not only feel but be productive and be part of the act. And we've got enough product to do that, but and be part of the act. And we've got enough product to do that, but we don't have. We're not perfect at figuring out how to make the bottom 20 or 30% in terms of abilities fit a new changing job profile. I really recommend you look at that Forbes magazine, because if you think through the implications of those charts, I think you'll see what social problems have to be attacked. Zone 4.
Edward Barr, Lexington, Kentucky. Earlier, you led us through a discussion of the competitive position of Disney, and you also discussed share repurchase. I wondered if you could also lead us through a discussion of the competitive position of Wells Fargo, since they just effected such a large combination, in addition with perhaps some discussion of their share repurchase, which is probably as large in percentage terms as any company I can think of at the present time.
Well, Wells should repurchase their shares if they feel that they're repurchasing them below intrinsic business value. Well, Wells should repurchase their shares if they feel that they're repurchasing them below intrinsic business value. And you should have to ask the question of them how what their calculus is of that. But that will determine whether that share repurchase program makes good sense or not. The advantages of an in-market merger can be dramatic. Sometimes it just causes a bank to do what they should have done anyway. I mean, I'm not always as convinced that the economies come about through what they should have done anyway. I mean, I'm not as always as convinced that the economies come about through look at how they run their. There's a CEO of the Bank of Granite, which is in Granite, North Carolina, and that bank earned 2.58% on assets. In Granite, North Carolina, and that bank earned 2.58% on assets, I believe. And now that bank is $400 million or $500 million of assets. You know, it doesn't need to be $5 billion in order to get more efficient or anything of the sort. It's so much more efficient than any of those larger banks that had to be put together to get those ratios that it makes you kind of wonder about the underlying rationale. But I'm sure that Mr. Forlines, who runs that bank, just focuses on, and he's been focusing on it for a lot of years, just doing the right things day after day, and it didn't take any in-market merger or anything of the sort to cause him to do that. I recommend any of you in the banking business that get his report, because there is nothing magic about the community of Granite, North Carolina, nor does he work under laws that are way different than the rest of bankers or anything of the sort. He just gets a record that achieved a record that makes all the rest of the records look silly. And we had a fellow over in Rockford, Illinois, in the bank we owned back in the 70s, Gene Abegg, who his brother is going to be 104. There was a fellow from Rockford here that got me to sign a note to Ed Abegg, who will be 104 soon. I wish Gene had lived to 104. But Gene ran a bank in Rockford soon. I wish Gene had lived to 104. But Gene ran a bank in Rockford that when bank, and he did it with way less leverage than anyone else, and lower loan losses, and big investment portfolio, and there wasn't any magic about it. He just didn't do anything that didn't make sense. And there's a lot of room for improvement in the banking business with or without mergers. But I would say that Wells, on the record, has done an exceptionally good job of running their bank compared to other big banks. And I would say that those two operations put together will be those two operations put together will be run efficiently than if First Interstate had been run. It's a business that can be a very good business when run right, as the Bank of Granite or our Illinois National Bank in Rockford proved. There's no magic to it. You just have to stay away from doing something foolish. It's a little like investing. You don't have to do anything very smart. You just have to avoid doing things that are ungodly dumb when looked at about a year later. And, airlines and that sort of thing. And that's the trick. It is not some great crystal ball game where you look into the future and see all these things that other people can't possibly see. I mean, what's complicated about Coca-Cola or Gillette or Wells Fargo, for that matter? And that's we like businesses like banking if we've got somebody in charge of them that is going to run them right. We've got I don't know whether Bob Wilmers is here, but he runs First Empire, which we have a good size investment in. And Bob just runs it right. I do not worry about surprises from Bob or First Empire, and he'll do things. If he can grow and it's logical, he'll grow. And if it isn't logical to do something, he'll pass. He has no ego compulsions forcing him into some sort of action, and he runs a terrific bank. Do something, he'll pass. He has no ego compulsions forcing him into some sort of action, and he runs a terrific bank.
Dorothy Craig from Seattle, and I noticed in the annual report that your recent acquisitions doubled.
Well, for one thing, we started from kind of a small base. But the Geico acquisition, added $3 billion or so of revenues, and actually more than that, a little more than that, but not much more. And R.C. Willey and Helzberg's probably added $600 million or so in the current year. And since we were working off a base of $3.5 or so billion, those three acquisitions did. And since we were working off a base of $3.5 or so billion, those three acquisitions did help double the revenues. We won't have many years when that happens. It's not any goal of ours to double the revenues or increase them 20%. If it comes along that makes sense, we'll do a lot. And if there's nothing that comes along that makes sense, we'll do nothing. So there's a lot of accident in it. But last year, a fair amount happened, and I'd love to see a lot happen next year, but we don't know at this point. Charlie?
Nothing.
Zone 6.
Me? Yes. My name is Victor LaPuma, and I'm from the Virgin Islands. And my question is on the Geico asset side. One of the things that makes Berkshire unique is the high percentage in equity as opposed to fixed assets. And Geico, as of the end of the year, looked like a typical insurance company with 4 times the fixed assets as equity assets. And my question is, over time, will they have the same composite as Berkshire on the asset side? And the second part of that question is, how are the asset allocations decisions being made at Geico after the merger as compared to before the merger?
The decisions at GEICO, which as you say is about $5 billion of marketable securities, have been made and are being made and will be made by Lou Simpson. Lou has done a fabulous job of running the investments of GEICO since about 1979, and we're lucky to have him. The investments of GEICO since about 1979, and we're lucky to have him. There's over, but we're delighted in the case of Lou. I mean, it's 1 in 1,000 or something, but Lou has done a terrific job. Will do a job, and the one thing we offer him, he has the ability to do whatever he wants to do with those assets now. He did not have that ability before GEICO became part of Berkshire, because at that time there were certain ratios that were necessary which were understandably necessary, that made sense. Where with GEICO as a standalone entity with its own net worth of $1.5 billion or $2 billion and doing $3 billion of business, it would have been inappropriate for him to take on a different configuration beyond a certain point in equities. So he was constrained by the nature of the business he was in and its capitalization. That constraint no longer applies. So he, with that $5 billion, can do whatever he wants. Now, if he does certain things, we would need to provide backup to GEICO so that their policyholders would be protected under the most adverse of circumstances. But that's no problem for us. We could do it by quota share reinsurance. We could do a lot of things. We could just guarantee their obligations. And we're in a position to do that. We haven't done it yet because hasn't been necessary yet. But if it made sense, if Lou wanted to be $5 billion in equities and it made sense, we would arrange things so that the GEICO policyholders would be every bit as secure as under the most conservative of investment portfolios. So Lou has another string to his bow now, and there may be a time when it gets used. He's been great under the old system, and he may be better under this system.
That's a very shrewd question. You're to be complimented.
That means it's something we thought about before. But you are to be complimented, right? Let's see. Zone 1?
Neil McMahon, New York City. Berkshire owns several companies, stock in several. Neil McMahon, New York City. Berkshire owns several companies, stock in several peer market, the one decision stocks, high PEs, 50, 60 times earnings. If that were to reappear again, would Berkshire's companies still be permanent, or is there a price for everything?
Well, there are things that we think there's no price for, and we've been tested sometimes and haven't sold them. But my friend Bill Gates says that it has to be illogical at some point. The numbers at some price you have to be willing to sell something that's a marketable security, forgetting about a controlled business. But I doubt if we ever get tested on. There's only a couple of them in that category. Actually, I won't comment on that. We really have a great reluctance to sell businesses where we like both the business and the people. So I don't think we really have a great reluctance to sell businesses where we like both the business and the people. So I don't think that means keep an eye on me, Charlie.
The so-called two-tier market created difficulties, I would say primarily because a lot of people, companies were called Tier 1 when they really weren't. They just had been at some time Tier 1. If you're right about the companies, you can hold them at pretty high values.
Yeah, you can really hold them at extraordinary levels if you've got. It's too hard to find. You're not going to find businesses that are as good. So then you have to say, am I going to get a chance to buy back the same business at a lot lower price, or am I going to buy something that's almost as good at a lot lower price? And we don't think we're very good at doing that. We'd rather just sit and hold the business and pretend the stock market doesn't exist. That actually has worked out way better for us than I would have predicted 20 years ago. I mean, that mindset has, or 25 years ago, that mindset is, there's been a fair amount of good fortune that's flowed out of that I really wouldn't have predicted.
But there-
Of good fortune that's flowed out of that I really wouldn't have predicted.
But there-
Zone 2.
Alan Rank, Pittsburgh, Pennsylvania. Knowing your aversion to technology, but your close affiliation with Bill Gates, Microsoft, have you ever considered either inviting him to be part of the Berkshire through the board, or being involved to maybe solve some of the problems with World Book in taking it to the new technology and expanding it? And on the other end, you also love insurance and the float. Have you considered the other businesses that would have that similarity, such as cemeteries and funeral homes with their pre-need and their large cash reserves?
Bill and I talked about encyclopedia business some years ago, but he was pretty far down the line in Encarta, quite far down the line in Encarta, actually, before I even met him. So it wasn't. My guess is if we'd met earlier, there might have been something evolve in that. But he had put a lot of chips on Encarta and had done a good job with it. So it really wasn't. It wasn't a real option to work with him on World Book. Bill also is very focused on his business, and I believe he's on the board of some biotech company in which he's got a significant investment. But you will not see him on the boards of at least I don't company in which he's got a significant investment. But you will not see him on the boards of at least I don't Pacific Northwest, where he has a lot of friends and knows the companies well. Maybe grew up with some of the people, but I don't think you'll see him on anything which really doesn't. Which is just a business that doesn't grab him intellectually on something. And I do think there's one biotech company that he's involved in that way, and he'd be a terrific asset. But he really focuses on Microsoft. He has his board meetings, as I remember, on Saturday. They last all day, and he goes after the business that way. He's not. I don't think he'd be interested in being on a bank board or an insurance company board, because he just figures he's got other things to do with his time, and I think he's probably right. Zone 3? Oh, the question was about other kinds. We've always had an interest in float businesses of one sort or another, but blue chip stamps was such a business until it disappeared one day. We couldn't find it. We looked in the closet, right. Looked everywhere, out in the backyard. Right. Where was it? So we like that sort of business, but most of the float businesses, the costs are pretty explicit, and like I say, we don't like most insurance companies as float businesses. We are not interested in buying the typical insurance business because we think the float will end up costing us too much. We'd rather borrow money with an explicit cost attached to it rather than have the implicit costs of an underwriting loss with most companies. But we are interested in businesses that provide cash rather than use up cash. We're willing to have them use cash if what they use will produce high enough returns, but we've got this bias toward things that throw off cash. Charlie?
Well, if we go into the pre-need funeral home business, that'll be the day.
Yeah. Zone 3.
Charlie's a difficult act to follow. I'm Robert Keeley from Washington, D.C. I have a brief comment and a brief question. The comment is that I think you may be considerably underestimating the interest there will be in purchases of Class B stock later this week and next week. I have at least 10 friends in Washington who are aware that I'm a Berkshire shareholder and that I was coming to this meeting, and they've insisted that I report back who are aware that I'm a Berkshire shareholder and that I was coming to this meeting, and they've insisted that I report back to them tomorrow on just what happened with the Class B stock, because they're very interested to even the shareholders who are present here today. You're talking about tens of thousands of people who are going to be in that market. And my question relates to liquidity. On page 18 of your annual report, you say, and I quote, "The prospect that most shareholders will stick to the A stock suggests that it will enjoy a somewhat more liquid market than the B. Could you explain that? It seems to me that if most shareholders keep their A stock, do not convert it or sell it, that the B stock will be much more liquid. Maybe I don't understand liquidity.
No, I think you do. You understand it, and I'll elaborate just a bit. Certainly in the first week, I would expect the B stock to trade far more, although I hope it doesn't trade like most new issues trade in relation to the amount sold. It's just the nature of a new offering that there's usually most new issues trade in relation to the amount sold. It's just the nature of a new offering that there's usually there will be some flurry of activity. But longer range, let's just assume that there's $400 million worth of B stock out there. There will be $40 billion of A. Now, admittedly, I'm not going to do anything with my stock, and many people in this room have a very low tax basis, and except they're under very unusual circumstances, have no intention of doing anything with their stock. So of that $40 billion, there's a very significant percentage that you might say is almost inoculated against reaction to market changes. But there still is a very significant dollar value. There's a fair amount held by funds, for example. And so the market value of what I would call the potentially tradable A is likely to far exceed the market value of the potentially tradable B. Now, it may be that all of the B is potentially tradable, whereas only a small portion of the A is. But that 40 billion to 400 million ratio, I think, almost ensures that after the initial flurry, that the better market, and when I say better market, I mean the ability to move large dollar amounts in both directions with a minimal movement of price. The better market, not by a huge margin, but the better market is likely to be in the A, and frankly, we hope that it is. We still hope there's a good market in the B, obviously, but if you're talking 10 shares of the A, which is a $300,000 or so investment, I think that 2 months from now that it's likely to be that buying or selling $300,000 worth of A will have slightly less of a percentage impact than buying or selling $300,000 worth of B, but not by a significant amount. But that's what I meant by that comment of having a slightly better market in the A than the B. And that's important from our standpoint, because if that situation became reversed and the B became the better market, then people would have a real incentive to convert from A to B over time, and eventually the B market would dominate. We don't anticipate that happening, and I think the way we've arranged it won't happen, but it could happen. Charlie?
Yeah, well, I think we've also created arrangements in the way we've written the prospectus and rewarded the selling brokers that tend to dampen demand, both individual and institutional, and we sometimes accomplish what we try to do.
Zone 4? Don't ask us for a list of those where we've accomplished.
Dan Pico, Sioux City, Iowa. In the mid-'70s, you wrote an article on how inflation swindles the equity investor, and that the average return on equity for corporate America would be like 12 or 13%. Last year, the average was more like 20. Have the laws of economics been repealed or modified? Or if not, what sort of calamities might occur as we revert to the mean?
Yeah. Well, I have been surprised by returns on equity. There was a good article in Fortune about 2 issues ago. Well, it was in the Fortune 500 issue, whenever that was. And it discussed the question of return on equity, and it made some good points about how the introduction of putting post-retirement health benefits on the balance sheet tends to swell equity returns subsequently. And in other words, it moves down the denominator in terms of total equity employed. And there's been a lot of big bath accounting where there have been write-offs, so that counting that, I don't think it has gotten to 20%, but it's certainly higher than I anticipated when I wrote that article. And I would say that it would seem very extreme to me in a world of like we're living in now to have returns on equity close to the average close to the 20% rate over time. It has surprised me how high returns have been. Now, you have had situations like a Coke, for example, where 25 years ago, they would not have repurchased stock, and so they'd have piled up more equity in the business. And Coke's return on equity, if it had been following the policies of 1970 or 75, would be far less than it is now. Coke really doesn't need equity, and so it can be far less than it is now. Coke really doesn't need equity, and so that has some impact on them. To the extent that General Motors sets up many billions of a reserve for post-retirement health benefits, that tends to make the return on GM look a lot better than it did in the past, when it wasn't even recognizing those costs, and therefore had an equity that really was much larger than the true equity. So there have been some things happen like that, but all in all, I don't think under any system of accounting the 20% returns for American industry are in the cards. Charlie?
Well, I agree, and I think that this business of having way more consolidation and the successful companies like Wells Fargo buying in stock, I think that's had a huge effect too. I don't think it's actually gotten that much I don't think it's actually gotten that much, and on average, business has earned higher returns on equity. But I think a whole lot of things have combined to goose the results, and I don't see how it could go much farther.
Zone 5?
Yes, my name is Ted Elliott from Connecticut. The press reported a recent investment you made in the real estate business, and I wondered if you would comment as to your outlook for that business.
Well, that's just sort of an asterisk. I've got virtually everything in Berkshire, and I own a few municipal bonds outside and a few other things, but I don't want to buy anything that Berkshire's involved in. It just complicates life. And all the best things I like are in Berkshire. So every now and then some little thing happens to hit the radar screen that is too small really for Berkshire. And I bought 100 shares of that company back when it's called Property Capital Trust. I bought 100 shares of that back when we owned NHP, which had done a couple of deals with them. So my policy of reading every annual report in sight that can further my knowledge about anything, I bought 100 shares, and then I happened to see a year or so ago where they said they were going to liquidate. So having some money around, I bought that, but it's not based on any feeling about the real estate business, any sophisticated analysis of the company or anything else. It's a minor personal investment. I have no insights whatsoever. We've done a few things in real estate at Berkshire, but they've been large things. And there was a brief period when there were a couple things that were intelligent to do. If we'd started a little earlier, there might have been a lot more things, but we started a little late. So we're doing nothing now, but we listen to things occasionally. But we're basically looking for big things at Berkshire, and we haven't found anything in real estate in a long time, and we may never. But who can tell? I mean, we got our oar in the water, and the couple things we're in are working out fine, but they're not significant relative to Berkshire's size. We'll go to Zone 6, and this is the last question because it's going to be 3 o'clock, and let's have Zone 6.
Hi. My name's Mike Nolan from New Jersey. My wife and I have been shareholders since 1984, and happy ones. Thank you both. 2 questions today. In the retail store industry, in light of Berkshire's outstanding 23% annual growth in book value per share, and the industry's roughly 8 to 9% growth in equity over the last several years, we wonder, why would Berkshire exchange stock for securities such as these when the growth and the net worth of the acquired companies, if they're anywhere near the industry average that you've acquired this year, are 1/3 or less? To quote Bartlett average that you've acquired this year are 1/3 or less. To quote Bartlett Helzberg from the annual report,
competitive, and both of those companies have averaged a lot better returns on equity than the numbers you cite for the industry. And the second point, we have no way of making 23.6% in the future, so we do not use our if we used our historical average as a yardstick for new investments, we would make no new investments because we don't know how to make 23.6% in the future. But we regard the retail business as a very tough business. We like the records of those companies, their market positions, and their managements. And when we find a business like that, and we feel very comfortable with the people running it, we will make the deal, but we won't expect to make 23.6% on our money over time doing that. I'd like to thank everybody for coming. I've had a good time the last couple of days, and I hope you have.